Hi, everybody. Welcome. We have a special treat for you today. Joining me is J.L. Collins, author of one of my favorite finance books over the last decade, The Simple Path to Wealth. This book has gone on to sell over 500,000 copies. I mean, mind-blowing. Congratulations, JL. But this book certainly deserves it. It really simplifies investing, and it does so in a very approachable way. So, JL, thanks so much for joining me on the channel.
Thank you, Brian, for the invitation. I'm honored to be here, and I appreciate the wonderful introduction.
So I want to jump right in. You are well known for talking about investing in the stock market, investing in the bond market, and a lot of people that watch my channel really started investing just within the last, let's say, 3 years, or they got started investing in 2020. Millions of people invested for the first time in 2020.
Right.
And unfortunately, the thing that a lot of people learned right out of the gate is buy anything, it immediately goes up. And the riskier the thing you bought, the faster it goes up. What we've seen over the last year, roughly, is the exact unwinding of everything that strategy. So first, I just want to get your thoughts. How can people, specifically new investors, really handle these massive swings that we've seen?
Actually, to comment on it, it goes back even further than 2020 when I started writing my blog in 2011. After the massive downturn in 08, 09, that was really the last time until this past year the market really pulled back at all. So for about a decade, it did nothing but go up. And until last year, that coincided with the decade I was writing about this stuff. And it occurred to me there's a whole generation of investors that came of age in that decade who understood maybe theoretically that things could go down, but never really experienced it. And there's a huge difference between understanding that theoretically and living through 08, 09, or even last year, which by my take was pretty mild.
For certain. I personally started investing in about 2007. So my first introduction into downturn was everything you buy goes down really hard immediately.
Baptism by fire.
100%. 100%. And the other thing that I learned during the last kind of like 14 years, or an experience that I had, and a lot of people have had, we've been investing essentially in a zero interest rate environment over the last 14 years. And I think that has significantly warped a lot of the valuations that we've seen and kind of the returns that we've gotten. So just dealing with the unwinding of that is being extremely challenging.
Yeah, I started investing in 1975, which was, the 1970s were the age of stagflation, very high inflation, stagnant economy. Business Week, I think in 78, came out with their now infamous cover, The Death of Equities, predicting that stocks were just over. That was done. We weren't going to have stocks anymore. And of course, that was just a year or two away from the beginning of the next great bull market. So those things always come and go as the fashions are, I guess.
So one thing that I think your book does really well, and I tried to kind of add on to this with my book, was explaining why the stock market, first off, has these gyrations, but more importantly, why the stock market will always eventually recover and always eventually come back. Just would love to hear your thoughts on that. Why should people have faith that the market will eventually bottom and that it will eventually go back up again?
Yeah, I think they ought to read your book. I mean, you have a whole book that does a brilliant job of explaining that. But as long as the United States is a viable country and that we have a capitalist economic system that encourages innovation and problem solving, then we will be generating wealth. And the market goes up because as a society, as individuals collectively, we generate wealth. Wealth is created. It is not, as a lot of people seem to believe, a stagnant pot of money that some people dip into more effectively than others. Wealth is something that humans create. And as long as you have an economic and political environment that encourages that creativity and that entrepreneurship, then you're going to create wealth. And as long as you do that, that has the potential to expand almost without limit. And technology, of course, encourages that and facilitates it. And I see that continuing.
I obviously totally agree with you. The vast majority of my personal net worth is in the stock market, so my money is where my mouth is on that one. But to your point, I think a lot of people have a hard time conceptualizing that. Yes, they might understand that historically wealth has been created, but they have a hard time believing that wealth will continue to be created moving forward. So I really hope that everything that you said continues to be true. I'm certainly betting on it. But let's take the other side of the coin. Is there anything that could anything happen in the real world that would really change that perspective?
Well, I mean, sure. If there was a major war fought on U.S. soil and our infrastructure was destroyed, as happened in large parts of Asia and Europe and during World War II, absolutely, that's going to be a major setback. If we as a country decide that we don't want to be a capitalist democratic political economic system, and we go into communism, for instance, then that will change that dynamic. So certainly there are factors that can change it. And of course, nothing lasts forever, and that includes the United States. So you have to sort of look at what you think is going to happen. I know people, and I imagine you do, and there might even be some folks like this listening who don't believe the country has a future. They're preppers. They're building bunkers and stocking them, and if that's your belief, then you probably don't want to follow my advice. You probably don't want to invest in the stock market because there's no future. You have to have a certain amount of belief in the future of the country to follow the path that I lay out. But then I suggest if you don't have that belief, your options are pretty limited as to what you do with your money, how you secure your financial future. And I personally can't think of how you do that other than canned goods and shotguns.
Right. But bullets and canned goods are really the only two things that would survive the stock market really not working in the long term.
So to a certain extent, if I'm wrong about where the country's going, it really doesn't matter what you invested in. We're splitting hairs at that point.
For
so
certain.
The question becomes, if you believe the country has a future, what's the best way to capitalize on that future?
Well, let's talk about that. What is the best way to capitalize on that future? I put out on my social media platforms, I'm interviewing JL, what kind of questions that you have for him. One of the top questions was, what is JL's current asset allocation?
Well, currently, first of all, I've been an advocate of only 2 funds, and maybe 3 if you count a money market fund. And that's where I am at the moment. And I'm a fan of Vanguard. So these are Vanguard funds, but I have a total stock market index fund, VTSAX, which I'm kind of famous for. But you can have a total stock market fund. That's Vanguard. You could have a total stock market fund at other companies like T. Rowe Price or Fidelity or what have you. And then you want a total bond market fund, at least if you're at my age or you're retired. Because that's ballast, if you will, for your stock portfolio. And my personal allocation, I think the last time my target is 80 and then 20 between bonds and cash. So probably 19% bonds and maybe 1% cash. I think right now I'm at 79% stocks because of what's going on in the market, and probably 20 in bonds and 1% in cash.
Thank you for sharing that.
Yeah.
So over the last, let's say, 15 years, essentially since the wake of 2008, personally, bonds have made 0 sense to me at all as an investor, simply because rates were so low. And while inflation was low, I was like, well, there will come a reckoning day eventually where interest rates go up. And when interest rates go up, that just decimates bonds. For the first time since I started investing, I'm actually now considering adding bonds to my portfolio because yields are finally starting to make sense. I don't want you to give me personal advice or anybody personal advice, but generally, how do you think about, how should an investor think about bonds depending on how old they are?
Well, that's in some ways that's two questions. So let's talk about how should you think about bonds generally, and then sort of play into the age part of that question. So the first thing is it's not just about interest rates, because you can't look at interest rate, or you can, but you shouldn't look at interest rates in a vacuum. So it's a function of interest rates against inflation. So when I started investing, I mentioned in the 1970s with stagflation, I remember you could buy treasuries that were paying, if I remember correctly, 18% for 30 years. And people say, my goodness, I mean, that's amazing. But inflation was running at 20 or 22. So you actually had a lower real return. You had a negative return on those, whereas a couple of years ago, you might have bought a bond, the 30-year bond that was paying 2% or something, but inflation was essentially zero. So you had a more positive return 2 years ago than you did when ostensibly they were paying 18%. So you have to bear that in mind when you're looking at bonds. It's not just the interest rate. In terms of age, it's not so much that I'm the age that I am. It's that I don't have earned income. I think I talk to an audience that is frequently focused on retiring early. So what I say is you want to add bonds to your portfolio when you don't have cash flow from earned income. When you have cash flow from earned income from a job, for instance, then I think you ought to be 100% stocks, because you have that cash flow to take advantage of years like last year when the market drops and it offers you stocks on sale. If you don't have that income flow from your labor, then you probably want something like bonds for your ballast, where you can draw on that part of your portfolio as you rebalance, as your stock prices go down, to take advantage of those lower prices. So it's more what's going on in your life than your age. Now, having said all that, when you get to a certain age, you are much less likely to have earned income.
I think that makes complete sense. I hadn't thought of it before as in it's just a function of do you have earned income
Right.
or not, but that's an interesting way of doing it. The classic way of doing it is you set a bond at a certain percent and you just inch it up over time. That's what a lot of the target date retirement funds, but it's an interesting mind shift to say, no, it's just a matter of, do you have income or not?
Well, of course, that comes from the traditional way of thinking about a life and a career. When I was young, nobody talked about early retirement. That just wasn't a thing. You went through school. Hopefully you got a job. Hopefully you were able to hang on to that job for the next 40 years or whatever until you were 65, and then you retired. And so even then, it was really a function of whether you had earned income or not. It just happened to coincide with your age, right? But now we have a whole generation of people who are living life very differently and much more creatively, and for my take, much more excitingly. So you might go in and out of that phase you might retire at 30 and decide I'm going to pick up some bonds, and then at 35 start a business or go back to work, and then maybe you want to set the bonds aside. And so you can go in and out of what I call the wealth accumulation phase and the wealth preservation phase over the course of a lifetime.
That's a great way to think about it. And I think we both know many people who have done exactly that. They've gone in and out of the wealth accumulation and wealth preservation phase.
It's kind of the market we write for. But the other thing is that I've never quite bought into is the idea that you should have steadily more bonds just because you're getting older. Now, the thought process there is you're focused on your needs and your life. I don't know anybody who attains a certain level of wealth as they get to be my age, who is only thinking about their own needs and their own wealth. They're thinking about their children, their grandchildren, the charities they support, the people that in the institutions that they're going to pass that money on to. And those all have long time horizons. So I've never quite bought into this idea that your time horizon should shrink as you got older. Now, if it's just you and you have no intention of passing anything on to anybody, including charities, then maybe that makes some sense.
Thank you for that. I think that does make sense. And like you, I know a lot of people that when they get to 60s, 70s, 80s, they are thinking, this is for my kids, this is for my grandkids, this is for whatever I support. So in that vein, I agree. It still makes sense to have exposure to equities, since those are the things that have historically beaten inflation over long periods of time. Bonds have a more mixed record.
But this is very much at odds with the standard advice that people get.
For sure. Personally, I'm a fan of hearing lots of opinions and then taking those opinions and thoughts and forming my own. And I think that everyone should do that. You shouldn't take anybody's advice in a vacuum, mine, yours, anybody's, but seek out a variety of opinions, right. Answer what makes sense for you personally, and pursue that. Shifting gears a little bit, your second book, it was all about your experience losing money the fashionable way in right. the real estate by using real estate. And you tell a great tale about how you bought into this asset class that so many people think is can't lose, only goes up, and you just had a horrendous experience with it. I won't ask you to retell the tale about that. You wrote a great book on that, but I would love to get your thoughts about investing in real estate in general. Do you think it's a good asset class? Who should look into it? I mean, so many people are promoting real estate investing online. We'd just love to get your thoughts on it.
So yes, I think real estate's it can be a great investment class. But if you're going to invest in real estate, it's a business. And it's like going into any other business. You need to take the time to learn the ins and outs of that business, the nuances of that business. And you need to approach it as a business. And if you do that, and you do it well, then you will make money in real estate. I didn't do that when I bought my first piece of real estate. And I didn't realize it at the time, but I made virtually every mistake you could possibly make. Guy bought this, it was a condo in Chicago. I bought it initially to live in, and I won't go through the whole litany of things. And then it morphed into an investment, a rental, and which is not the way you want to go into rentals. You don't want to back into them. And so anyway, it's a litany of all the things that can go wrong, because my objection to real estate is not as an investment class. It's to the drumbeat out there that somehow this is easy. And that's the message that I hear all too often. It's not easy. It's being a good investor. Like any business, it's hard work. And the rewards go to the people who are diligent and do the work and apply the lessons well. I think too many people are lured into it, thinking that it's somehow quick and easy and always profitable. And it is none of those things. And the other final thought I'd leave is that if you're comparing real estate returns to, say, stock market returns, you're really comparing two different things, because you're comparing an investment class with a part-time job, because you're investing in, unless you're investing in REITs, which is a different thing. But if you're investing in hands-on real estate that you own individually, you, as I said earlier, that's a business. So it's partly an investment and partly a job, a part-time job. So if you think about it in those terms and you say, is that what I want to do with my spare time? And if it is, that's wonderful. Do your homework, and that can be a great result. But you're comparing it to index investing, which takes virtually none of your time. And then that extra time you would have spent on your real estate, you can deploy in some other fashion, maybe in your career, maybe in just spending more time on the beach, who knows? But only you individually can make the decision as to which of those is more appealing to you. But you need to understand that's the decision you're making.
Well said. Can you double click on REITs a little bit there? That's something I would love to get your opinion on. I assume if you endorsed REITs, you would endorse an index fund of REITs, but I'd just love to get I've never heard you opine on REITs before.
So, well, first of all, to define it for anybody who doesn't know, a REIT, REITs, it stands for Real Estate Investment Trust. And basically, it's a mutual fund of real estate holdings. So you can buy it just like you would buy an index fund. You don't have to do any of the work of running the properties or choosing them or buying or selling them. And of course, there's management costs that come off of that. So it is not going to be as profitable as doing it on your own might be. I used to own REITs, and I own them as an inflation hedge. And I've written about this on the blog, by the way. I think the last time I owned REITs was before I published the book. So it was probably 2013, 2014. And it just finally occurred to me that it's not a particularly good inflation hedge. Regular stocks are better at hedging inflation, and I already had those with my total stock market index fund. So in owning REITs, what I was really saying, and of course, when you have the total stock market index fund, you do have REITs within that, just like you have all kinds of sectors within that. So it occurred to me, owning a REIT fund really meant what I was saying is that I expected real estates to outperform all other segments of the economy that were in my total stock market fund. And the truth is, I didn't particularly expect that. I had no idea how they were going to perform, whether they'd outperform or underperform, but I didn't have an opinion on that. That's not why I was owning them. And the reason I was owning them no longer felt valid to me. So that's why I got rid of them.
I personally don't own many REITs at all, but the increasing yields do appeal to me. So that might be something I check out at some point in my life. Mm-hmm. Well, thank you so much for your time today. I do want to wrap up by talking about the book that you're writing. It's called Pathfinders, as I understand it.
It is Pathfinders.
Tell me about it.
Well, Pathfinders, it's something that I've wanted to do almost since the moment that The Simple Path to Wealth came out, because very shortly after The Simple Path came out, I started hearing from people who read the book and were implementing it in their lives in wonderfully diverse ways that I frankly hadn't thought about, because I wrote The Simple Path to Wealth for one person, and that was my daughter. So I was once asked, why is the advice so specific? It's because this is exactly what I tell my daughter to do. And she was, when I was writing it, she was a teenager and at the very beginning of her adult life. And the book reflects that. It's a great book for somebody that's just starting out. But what amazed me is that people who were well on their life's journey, in their late 20s, in their 30s, in their 40s, who had maybe found entirely different investment approaches that they had to unwind, or maybe even lifestyle inflation that they had to unwind in order to follow the Simple Path, or even people from around the world, because the Simple Path is a pretty US-centric book, because I'm an American and my daughter's an American, and that's what I know. It's amazed me how people from around the world have adapted the principles to their own countries and the opportunities that exist there. So those stories always fascinated me, and I always thought a perfect follow-up book to The Simple Path would be a collection of those stories. So that's what Pathfinders is. It's a collection of about 100 different stories from around the world, from people at all different stages of their life, all kinds of different challenges and opportunities, and all centered around how they took the principles of this book that I only intended for one person and have made it work for them. And some of the stories are just absolutely inspirational. I have two that I put up on the blog recently, just as a sample. The most recent one's from a guy in Russia. And it's, how do you deal with this when your country's become an outcast?
Hmm.
And the one before that was a guy in Ukraine. How do you follow the simple path when your country's been invaded? I mean, that's incredible. And then, as I'm sure you have the experience, we talk to people who have everything going and all the opportunities that you have in this country, and they're like, oh, nobody can possibly do what you're talking about. Like, well, yeah, maybe you can't because you've convinced yourself you can't, but people can, and this is 100 different ways that people have done it. So I'm real excited about it.
Well, I have a feeling that is going to put lots of things into perspective for people. I mean, here, us investors have felt bad for ourselves that our portfolios are down, but our country wasn't invaded, right? So I can't imagine trying to think about money in that situation, right?
Yeah, and yet you have to, because life does have to go on.
Awesome. Thank you so much for your time today. I wish you huge success with your book, but I just know it's going to be a success from the start.
Well, thank you. It's been a lot of fun hanging out with you. And as I said at the beginning, I appreciate the invitation.